We're issuing a record amount of debt this year, as I understand. The last debt management strategy came out early in the summer. I think about $620 odd billion has to be issued this year. Is that your understanding as well? Okay. If the government is saying we will spend less and invest more, in theory, these investments will have a return, of course, because investments do have returns. But they continue to borrow short-term debt instruments. How does that, usually you try to match your assets and liabilities, but if you continue to borrow on the short end of the curve, as they say, but making long-term investments, does that not increase the risk to taxpayers that as interest rates change, taxpayers are, and the government's far more exposed to these sensitivity and interest rates such that, our debt service costs could actually increase much more quickly if rates were to go up for any reason? I'll note the rates were dropped recently, but the 5-year yield actually increased after the Bank of Canada increased its rates. Is that your understanding as well? We should be looking at the matching of assets and liabilities?
I think duration matching is a pretty fundamental principle of borrowing and investment to make sure that you're not exposed to fluctuations in the financial market, and you need to come up with cash when in fact you can't because the money's tied up in longer term assets.
Right. Or it's an admission that actually what you're doing is just borrowing to do the operations of government. You don't have to answer that. I'll just leave